Good day, all. Ira Epstein of Linn Associates with your agriculture update for this Monday, the 20th of May, 2019, and we're about 3:40 p.m. Central Daylight Time. Well, the event of the day in agriculture was the crop reports and how the progress is going on everything that's being planted. And as you know why, if you just turn on your news at night, you see how the weather is going. So let's for a moment just go there and then we'll come back to the prices. Corn planted progress was 49% complete compared to last week's 30% and a year ago 78%. So we're far behind. We're still 39% behind, but I'll get to that in a minute. Soybean planted 19% compared to last week's 9 and a year ago 53. Cotton planted at 44 versus last week's 26 and a year ago 50. And spring wheat 70% compared to 45% last week and 76. I don't see the cotton and the wheat being problematic. In fact, the soybeans, even though it's such a low number, you have a time frame to catch up with all that. The corn market's the question, and I say that because 49% is very close to 50, and that's basically what the market was looking for, was 50%. Where it was caught up was Iowa. Now, we had a discussion in the office, and it's been a long-going argument since GMO type of grains came about. And the question is, in the old rule of thumb, you had certain dates when you got your seed in. If things didn't happen and you couldn't get it in, they weren't germinating, well, then you started yield loss. Yet, when you get these new GMO strains that we're all, basically, that's what we sell, that's what we're consuming, that changes a bit because it just puts more onus, if you will, on summer months. That's not to say that the market hasn't come up. And in all fairness, we thought that anything near $4 was going to see a lot of farmer hedging. I can tell you at our firm, we saw big time activity last night as the market was up here in these ranges right through the day when traders were, and I'm talking the commercials, they were actually, we think, selling a lot of corn. I'm not going to tell you the months and all, and they were buying calls in case the market decided to run. But they were putting that in, and if you think about it, it's insurance. You can only lose X amount on the call that you're buying. It depends obviously on the strike you're putting in. And by selling the futures, nobody says you got to stay to the end anyways, and the deltas will change on all that, meaning the speed that the option price moves versus the futures. So we're up at pretty strong areas here where the farmer's probably getting somewhat enticed. There's also going to be a certain amount of acreage that if it keeps raining like this, the farmer's just going to say, I'm going into the prevent program. I'm not going to plant. I'll put weed control on the grain and the heck with it. That's going to happen in some areas. You just got so much water. When you take a look at the weekly area chart of soybeans, you got down to 797. You've come back now to 831 3/4. So very quietly, we've had a 35-cent rally. I would imagine anything getting up to that 18-day average is very enticing. I have my doubts if it's going to get there, but you just don't know. Weather markets can do anything. I mean, anything. You've got to keep that in the back of your mind. What we have in the market temporarily is a pattern with today's action of higher lows. We've already had the higher high, so that's bullish. What would turn this bearish is just getting under Friday's low of 820.5. That could give you lower highs, lower lows. I'm assuming the market's not going to jump sharply higher off that 19% figure. I say that because if you look at where the battleground has shown up, it's right here. It reminds me of this action back here. The 18-day average of closes is often an area that the market goes to try to figure out what to do next. Notice how the market hasn't closed over this number. So it's keeping itself away from bias turning up. The bias is down, the swing line is up. When we look at Bollinger Bands, this was the collapse in prices. You can see how it just ran that band. Then it went back to the 18-day average where neutrality's in, but you got a fight going on. Momentum is still pointing up. Momentum often leads price. The bias is down because you're at the 18-day average of closes and under it. And if you take out 820.5, the question is, does that throw out a new sell signal as long as you don't take out 848.25? So that 18-day average is turning out to be the all-important number. If we take a look at meal, it's not so different. You have, with today, higher lows and a higher high. Difference here is you finish today at 297.30, which is just over that 18-day average of closes. So the bias is up. Momentum is up. Trend is up. What would turn this down is getting under 293.70. So now the bulls have to defend this position. And the question is, was this report bullish enough to do so? In the soybean oil, it's very different. You've got a lower low, higher high pattern. Notice how many days you've been trading at that 18-day average. Often that is what markets do. They get to a number, often it's that 18-day average, and they'll sit there trying to figure out what's their next move going to be. Now, the corn market's been on a tear. It has gone from 343 to today's high of 391.5, almost a 50-cent rally. Is that enticing enough for the farmers to come in and the trade to say, this is where the hedges are coming in? Don't know. Corn is the all-out weather market at this point. You have with today's close over the upper Bollinger Band. You were over it on Friday. You were over it on Thursday. You were not over it if you take a look on the day before. So we have 3 days in a row over the upper Bollinger Band. I count each successive day over it as one of the 5% of the time that the market trades outside of the Bollinger Band and stays there. So I give the market in this range a 2% chance of staying over that number tomorrow, and if it gets into Wednesday, a 1% chance. Because the market sliced right through the 100-day average, I've got to ask myself, if it breaks, will the market find support at that 100-day average? You are overbought, not in a trend. You're in what we call one of those zip lines straight up. In the wheat market, you've gotten up high enough now where the market's in a serious resistance area. The 100-day average of closes, you're now, today you were over the upper Bollinger Band. You were over that band also on Friday. You were not over that band on Thursday, or were you? No, you were. That's an update right there. So that's 3 days, and this day you finished actually under it. So you have 3 days in a row over it, into the 100-day average, and overbought. I'd be very surprised if this market doesn't stall right here. It's not to say the trend isn't up. It is until you break through under the current pattern, 446.25. In the sugar market, you've been in a downtrend. You still have what we call an embedded reading. Embedded occurs when the two numbers that make up the slow stochastic oscillator, the momentum oscillator, SSTO, and they're both sitting under 20 sideways for several days or more. And what that often means is on rallies, you're going to see professionals selling the market until that red line gets over 20. And at that point, the brakes on selling often come off. The market now starts fighting a battle. If it stays off, in other words, over 20, then I look for price in the 18-day average to come together. You're not there yet. So I'm still seeing a potential here for selling in this market. The coffee market keeps failing at the 18-day average of closes. You see that. You had a good chance to do it the other day. This was last Thursday when you had the outside day up. You had the swing line up. If you took that out, odds put in favor you're going to make a run for the lower Bollinger Band. You didn't quite get there. That doesn't mean you can't. Resistance is still the 18-day average. Target could be the lower Bollinger Band. In the cocoa market, the market has now turned its trend back up. Higher lows, higher highs. Now you have an outside day up, which means you took out Friday's low and high. If the market continues here, I look for some rather formidable resistance at that upper Bollinger Band because you're overbought if you head up to it. We'll see if that occurs. If you take out today's low, then the 100-day average could become the next support zone, but the market has turned itself to the upside. In the cotton market, you have a double whammy here of interesting chart action. You lost the embedded reading. Do you see how this number is over 20? Now, if I come before that, you can see you had successive days under that. So that means when you lose it, you have to keep it lost the next day. That often is the case when you close in the top part of the range of the day that it's lost. We'll see if that occurs. If it stays like that, then this market is setting up the possibility of pricing the 18-day average, and that's quite a run there. The problem that I saw is in the crop reports, I don't see any damage to this market, so it looks pretty normal to me. In the cattle market, you have a pattern of a lower low, a higher high. Now, if we come over here, this is what the embedded slow stochastic looks like. Remember, we just came off the cotton talking about that. If you lose it, often price and the 18-day average come together. In this particular case, it happened both on the same day. That's not normally the case as to how it works. Now you're stalling out. I don't see a trend. I see a market that's gotten back to that 18-day average and fighting to decide what to do. Let me come back to that, by the way. If you were to close over 109.77.5, get up and get through that number, you're liable to set up a pattern of higher lows, higher highs, and get a very interesting move, possibly back to the upside. I'd look to see wherever that Bollinger Band falls down for the resistance. In the feeder cattle, you've got the pattern of lower highs, lower lows, but divergence galore. Look at how momentum's pointing up, yet price action down. If this market takes out Friday's high, 146.05, and closes over the 18-day average, which is going to be lower than it is today, that could set up a potential buy signal in the market. Who's controlling the market right now? The bears, but with that divergence, I don't know. In the hog market, we have the pattern of higher lows, higher highs, bullish, momentum up, bullish, bias up, bullish. And boy, are there news stories for whatever reason. I don't know who pays who, but all of a sudden, all weekend long, we kept hearing about pig Ebola. It's not Ebola, it's African swine fever. And one of the things that's happening is in Europe, they're starting to get cures for this, but they're not out yet. They're not available at this point. They're working on it. The problem is when you get this, and there was another case discovered today in China, when you get it, you can't just leave the herd and say, I'll take out the few sick animals. The rate of contagion is almost near 90-95% in most cases. Therefore, generally, the whole herd is culled. So they're losing lots of pork. The problem for America is that that pork that's being sold to make up the difference in China is not from America. It's from South America is where a lot of it's coming. It's coming from Europe as well. So they are picking up the business. Obviously, the U.S. with this trade war isn't picking that business up. But as that other pork disappears around the world, our pork does get sold everywhere. So that's one way to look at it. The question many traders are asking, is this the low? One of the things I had told traders a long time ago is if you're going to take a shot on that African swine fever, work with your broker. Maybe you put on vertical call spreads. Don't take an out-and-out risk, but you can work that out with your broker. We write about all that. In fact, this vertical call spread, the reason I'm bringing it up is our firm has been discussing those in its newsletter. And that doesn't mean you should be doing it or not doing it. You know, trade ideas come and go, and they're as often as, well, there goes one just now. But as you can see, we write on all these different subjects, and how you get them is by email. They come in, you figure out which ones of our information you want. We categorize all the financials together, but we break out the grain separate. We break out the meats, the top trades, treasuries, give you a good way to work through it. How do you get this information? Well, number one, it is free if you haven't tried it before. Our customers get it for free. How do you get this? Give us a call. Go to our website. This is a great time if you're a grain trader or in the meat markets because you're getting all this action happening, and you can always click up here. When you get to our website, you'll see a carousel of free offers. Click on it, and away you go. I'm Ira Epstein. You have a good day. I'll see you all tomorrow.